Most people overcomplicate investing, and today I'm be showing you my exact personal strategy I'm using right now in the current market conditions. Okay, so in today's video, we're gonna be covering these 7 main things. That's gonna be number 1, why do most people fail? Number 2, what to do before you invest. Number 3, my investment strategy. And number 4, why I pick XYZ companies. And number 5 is my risk management strategy, which is gonna be probably the most important part of this video. So make sure you stick around and watch it. 6 is gonna be my strategy, and then 7 is gonna be more. So let's talk about why do most people fail, okay? Well, number 1 is they have too many options. There's too much information. They're overthinking. Oh my gosh, I don't know what stock to buy. Should I buy Tesla? Should I buy Nvidia? I don't know what to do. And most people end up doing nothing. They just get analysis paralysis. And I don't blame them because, I've definitely been there myself. Now, the school system didn't teach us this stuff for a reason, but I'll save that for a different day, okay? So we're just gonna keep this between me and you. Now, first off, we gotta build a foundation. If we have a weak base, everything's collapsed. So now we're gonna start by building the base, and by the end, you'll start to be able to work on the top of the pyramid. So first things first is, listen to this part well. I would highly recommend, before anyone starts investing, I'm not gonna lie, this isn't exactly what I did, but my situation was a little different, and I'll get to that in a second. But that is, you need to have at least 3 to 6 months of living expenses. Ideally, a year. If you have a year of living expenses, you're set. Personally, for me, since I'm younger, and I can get away with basically, I guess you could say, taking more risk, I only do personally have 3 months of living expenses because I hate cash. Because cash, just all it does is loses value, especially with the rate at which the government is printing money. And what I would recommend is, we'll get into the logistics later, but for example, what you can do is you can invest, you can still invest in the market, but also put a small percentage aside for your living expenses, basically like an emergency fund. Or if you're someone that really can't handle any risk, then I would just say, just get the 3 to 6 months of living expenses, and then start putting money in the market. That's probably the best thing to do, honestly, because that way, if the market goes down, you'll just be able to sit there easy breezy. Now, why should you do this? Why should you have an emergency fund? Well, you see that box there? If you don't want to end up in a box when the market inevitably crashes, because it always happens, recessions typically happen, every 10 to 15 years. Last I read one of my economic textbooks, and basically, I think the last one we had was during the 19. That wasn't really a recession, but it kind of was. It was an economic downturn. Right now, it looks like things are cooking up, but I'll save that for a different video. So, what are things that should be in your living expenses? So you got, obviously you can read it. I'm gonna read it out loud anyway, but we got rent, mortgage, insurance, gas, car payments, blah blah blah. What's important though? See where it says Netflix? You're probably thinking, I don't need Netflix to survive. You're right, you don't need Netflix to survive. But me and you both know, if you get unemployed and you're laid off, what are you going to want to do all day when you're sitting at home and you have nothing else to do? Obviously, figure out a way to make money, but when you aren't trying to make money and you're not looking for jobs, you're going to want to do something to relax. You're not going to be like, I don't have money to watch my Netflix because I didn't put the money inside my emergency fund. No, probably what you're going to do is you're going to take out a credit card even though you don't have the money, and you're going to buy it anyway. That's actually Close that Grant Cardone taught in his Close Survival Guide. Didn't mean to plug that book, but hey, it's a good book. But hey, that's why I had Netflix in there too. Also, if you guys like Starbucks or anything like that, I'll put it in there. My idea of an emergency fund is, obviously an emergency fund is only supposed to things you need to survive. But let's be real. I don't have a lot of discipline, believe it or not. I just make things I just make the things that are bad for me so hard to do that I don't do them. And I would recommend you do the same thing. So how do I save 3 to 12 months of living expenses? Because a lot of people are like, Aaron, how the hell am I going to do that? I can't even save a month's worth of living expenses, let alone 3 to 12 months. I can't even save $1 when I get paid. So we're going to get to that. So there's a couple things you can do. You can automatically save money. So you can do this by basically, most places do have this if you have direct deposit. So when you automatically get paid by employer, if you're a business owner, it might be a little bit different, but virtually the same concept. Anytime you receive money, a certain percentage of that money automatically goes to an account. And this is why you need to have somewhat of an idea of what your expenses are, because you're like, well, if you know that you're making $5,000 a month and you're spending $3,000 a month on, bills, you're like, okay, I now have $2,000 of basically stuff I can do stuff with. So that's a great way to put that. You don't have extra money you can do stuff with. And a lot of people just blow it. But if you have extra money, you can start saying, well, what if I just saved, 10% of every paycheck I got? So if I'm making $5,000 a month, if I just save $500 a month, right? That's the kind of the idea. Or I would say step two, these are other things you do. Increase income, I would say this is probably the best one. This is the thing, you can only cut coupons for so long till eventually you will reach the point where you're like, oh my God, I can't save any more money, right? So we got increasing income. So like I just said, this is a big one. After you figure out a way to increase your income, do not increase your expenses. This is a thing called life inflation. I think I'm gonna make an entire video about this in the future. But this is why so many people get trapped. They're like, we have been indoctrinated from the very beginning, most of the Western societies, that we need to always be consuming, we need to always be buying stuff. It's literally where the entire concept of competing with the Joneses came from. It's like, okay, if your neighbor buys a lawnmower, you buy a lawnmower. If your neighbor paints their house, you paint the house. You're competing with the Joneses. If they get a brand new Escalada, I don't know what the hell that car is called. The Cadillac Escalera. I don't know. I can't remember. You guys know what I'm talking about. That really nice Cadillac SUV, Escalada. I know it's something like that. You guys are gonna have to correct me in the comments. So I'm gonna move on. So we then have decrease your living expenses. So this, like I said, obviously you can decrease your expenses. Yeah, buy less dumb shit. I made it pretty clear there. So, or this is the best thing to do, is you do all three of these at once. This is actually what I did personally. I started doing all three. I figured out ways to increase my income, by becoming more valuable in the marketplace. I'd save more money and I'd stop buying dumb stuff. That's hilarious. I forgot to put that there. It says, why are you reading this? All right, so my investment portfolio. Now we're gonna get into the goods. Now, I only buy two assets, guys. Only two assets, all right? I buy the S&P 500. I had this one college professor that always said it like that. Hopefully he doesn't see this. He might be offended. He's like, S&P 500. He's from South Korea. No, the guys, don't get offended. I'm just having good fun. So the S&P, and then Bitcoin, baby. That digital gold. Now, I know the Bitcoin's a little controversial. Give me a second, okay? So this is how I go. I buy 75%. We're only talking about money I invest. I do other things with my cash. This is like, for example, I'm not putting 100% of every dollar I make into investment. I think that's pretty clear, but hopefully maybe one day. But anyways, so I buy 75% of the S&P 500 and 25% in Bitcoin. Now, why the S&P? Well, number one is diversification. Now, I hate this word so much because all the rich billionaires always go, oh, diversification. Like even not Grant Cardone, Warren Buffett, obviously, good old Uncle Warren, considered to be one of the best investors of the decade. I think he's been in the Forbes magazine. He's been like a billionaire for like 40 plus years, which is like unheard of. I don't know the exact time period, so don't quote me, but my point is he's been in there for a really long time, and a lot of people fall out of it, but he's been in there forever. And basically he owns one of the most successful hedge funds called Berkshire Hathaway. And basically a big thing for them is he always talks about diversification. But the thing with this is I find that to be ironic because he ended up making like his billions from like a couple companies. I think it's like 20 something like that. So take this with a grain of salt. But if you're just an average person and you don't want to put in any effort to like really dive into like financial statements and things like that and learn business, then this is great. Now, when I say diversification, I mean this. The S&P 500 is about the 500 richest companies. I don't want to say, I believe it's like in the US. So about the 500 richest companies in the US. I'm not sure though, if there's some companies out. I'll have to check after this, but 500 biggest companies, that's the main point. And basically, how it works is whenever you buy the S&P, you're basically buying all of them together. So it's basically a basket, because what you're buying is an ETF, which is an exchange traded fund, last I checked. And basically what it is just a basket. So you have a basket of all these different companies. You have NVIDIA, you have Apple, you have Google, Tesla, right? And then when you press the buy button, you're buying buying a certain percentage of all those companies at once. So the thing is, if you're buying more companies, then you have your risk is more exposed. And if you're buying more companies, the odds of you not losing money are higher. So it's overall a safer investment. But this is the thing, with less risk means there's less reward. And then that's why we buy Bitcoin, but I'll get to that in a second. And then I said with S&P, I believe the S&P has been around since like the 1950s. I know it's somewhere in the slideshow, but I think it's like 1957, something like that. And so it's been around for a very long time, and it's performed very well. It's averaged about, it depends on what source you're reading, but it goes anywhere as low as from 6.7%, that's like adjusted for inflation, to as high as 12%. But a safe return, I think it's fair to look for is like maybe between 7 to 9% per year, which is great because that's still better than putting your money into a savings account. Because on a savings account, you're probably getting, I don't know, maybe 3% if you're lucky on your money per year. Now, what's the downside? Obviously, if you have any money in the market, there always is some risk. That is because this thing, past results don't guarantee future results. That's something that people always forget to add. And that is, this is a big problem I have with S&P, and one of the things I really don't like about it. And that is about the top 10 companies make up for about 30 to 40% of the total value. For right now, the big thing is AI. So pretty much what's been carrying the S&P has been all of the AI companies, right? And the thing is, when the tech bubble bursts, it's obviously gonna go back up. Like AI isn't going anywhere. But when it does inevitably burst, because all big bull runs actually do eventually do burst, it's gonna hurt on the way down. But my God, if you are young, like you are gonna become rich as hell on the way back up. But this is the thing: people always love to talk about the 2008 recession, but they never talk about how many millionaires it made. And trust me, I will be that when the next big recession happens. Now, why does this matter? Like I just mentioned, when the tech bubble bursts, that's gonna hurt. Now, it's gonna go up, probably. Now, more reasons I like the S&P. Well, here we go. We got a couple of them. So number one is low risk. There's low management fees. So you can look into the actual specifics. Like I said, this video is not meant to be like a video where I'm teaching these things. I'm just basically telling you guys what I know. Now, basically, when it comes to low management fees, I've had mutual funds. Basically, so a mutual fund is similar to like an ETF. However, it's different as far as the management. So when I was with the mutual fund, I was paying fees very high compared to now. I think last I checked, I was paying like 0.3% fees, versus when I was with the mutual fund, my fee was like 5%, which is insane because you're thinking, well, if my money's growing 7% a year, I'm giving these guys 5% in fees. I'm like, that means my money's actually growing 2%. And then after that, I then get taxed, and then it's even less. Like, in lots of cases, some people are even losing money. Some people are like, Aaron, you just got a bad mutual fund. You're probably right. I probably did just get a bad one. But hey, I'm just telling you my personal experience. Oh my God, I was right. Long-term track record, 1957. That's when it started. And this is the thing. It's a hedge against inflation, the S&P 500. Pretty much all assets are. It depends on what source you're reading, but the thing I was reading, I think it was in 2024 or 2025. I don't remember the exact specifics, but I do remember in a recent years, either 24 or 25, the U.S. dollar ended up it was impacted by inflation and lost 10% of its value in a year, which is absurd. Now the thing is, if the U.S. dollar lost 10% a year, guess what also went down? Guess what went up 10% a year? The S&P, right? So what happens is they print more money. And then by the looks of it, they buy more assets. Matter of fact, that's exactly what's happening. They're printing money, they're buying assets with the money they're printing. And as a result, it's causing everything to go up. Like, I'm not gonna get in this right now, but it seems to me like the real reason why everything's been going up is because of inflation. What I mean is, it's not that, for example, a company is really becoming that much more valuable, but it's rather just that it's getting inflated by inflation. So what I'm saying is, okay, so the U.S. dollar lost about 10% of its value last year. If you want, I can put a description. I can put the article in the description below. So we have in the U.S. market lost 10% of its value. S&P went up 10%. So as a result, I didn't lose any money or make any money adjusted for inflation. So we didn't have higher liquidity. This just means that when you want to buy and sell, you can, and you don't have to wait. That's the beautiful thing about being in such a giant market. And then the nice thing is there is dividend income. It's nothing crazy. I don't even know what it exactly is. I think it's maybe like 3%, but it's still pretty good. And then this is the thing, you have automatic rebalancing, because this is probably the most important part. Like everyone's like, well, how could the S&P be performing so well over such a long time period? And this is the thing, right? So like I said, we have the 500 companies, and they cut the underperforming companies on a regular basis. So what this means is if a company is losing money and they're on the verge of bankruptcy, guess what? They're not going to stay in the S&P. They just take them out, which is good for the investors. And that's a big reason why it keeps going well. Now, this is the thing. The S&P is great if you're just looking for safe growth. And honestly, I would tell most people, and even I know a lot of people do this now, if you don't want to, if you want to play it nice and safe, that you don't have any market risk, for at least a reasonable amount of risk, you don't want to have like a high amount, then I would say you're more than fine just buying just the S&P. Like you could literally go 100% on the S&P and you'd be fine. But personally, I'm not just trying to play it safe. I'm trying to get rich as hell. And trust me, I'm on the track record too. So why BTC? No, don't get your head out of your ass. Don't look at me like that. Bitcoin, you dirty schmuck. Okay, so we got Bitcoin. So many reasons. I'm not here to convert anyone, but Bitcoin is great. I also do love Jesus. By the way, this is just a joke. I don't think Jesus would like Bitcoin at all because, the people that are behind Bitcoin, I'm not going to get into that on this channel ever, but there's some very shady characters. So Bitcoin, why is it so special? Well, I'm glad you asked. Well, it's digital gold. Well, Aaron, what makes gold so special? Well, this is the thing. There's this great book called The Bitcoin Standard. I would just say read that, then buy Bitcoin. I would say don't buy Bitcoin until you read that book. Unless this video was really that enough for you, but I feel like you should probably do more research before buying Bitcoin, especially considering I feel like it's one of the most demonized assets ever because all you ever hear is man loses entire fortune on Bitcoin, blah, blah, blah. Man becomes rich from Bitcoin, but he got lucky. Like that's all you ever hear, right? So gold. This is exactly what Bitcoin is. Bitcoin is the idea of it being digital gold. With digital gold, the idea is with gold, you can't make more of it. There's a finite supply. Well, arguably they are trying to figure out a way to make more gold, but we're not going to talk about that. So pretty much for all of time, gold has been a finite resource. There have been so many different forms of economies over the years that have had gold. Even in the US, we used to have the gold standard until Richard Nixon got rid of it, but he got rid of it for some of the reasons that people don't know about, but I'm not going to talk about that channel. But so we then had the gold standard, we then got rid of it. As a result, pretty much since then, the US economy has been, the dollar has been losing a massive amounts of value because there's nothing to hold its value. The idea is if your currency is backed by something, then it's harder to inflate and cause the economy to crash. So, yes. Okay, so also, why do I believe in Bitcoin? Well, a lot of people say Bitcoin is a scam. They say it's overpriced, blah, blah, blah. Right now my portfolio in Bitcoin is down a significant amount. I'm still putting money into it because I'm like, I don't give a damn. Because this is the thing, I'm playing the long game. And this is the thing right here. So the US, we are the biggest, one of the biggest asset holder of Bitcoin. And if I can tell you one thing about the US, man, and that is we don't lose. Whenever we lose, it's because we chose to lose. So it's like, we don't lose. So this is what I'm saying, right? If the US government, by the way, you can literally read it right here, largely held by the US Marshal Services and the Department of Justice. I'm not gonna lie, I'm definitely gonna look more into this, but even right here, you can see the source of Investopedia. Sometimes this Google AI just is kind of wacky, but this is from Investopedia, the source. So Bitcoin, it is controversial, and I'll make a video on that one day. And this is the thing, right? We all know Bitcoin can crash. Like I said, right now, Bitcoin is down a significant amount. At the all-time high, I believe Bitcoin was at 140,000. Right now, it's at 70,000 last I checked, right? But this is the thing. It's like you just got to buy more, and I'm going to get to that. But this is the thing. Everyone always says that Bitcoin is dead, Bitcoin is over, but it keeps going up, and I truly believe it's going to keep going up. Now, like I said, I can get into that another day. So yeah, you can see right here, this was the all-time high. At this point, we were like at like 100 and something thousand. I think it was like 140. I don't remember. And then even right now, you can see it's like at 74,000. So it's down significantly. But if you look here, what I'm saying is I'm not going to get in there right now, but Bitcoin always does this. Bitcoin has a massive crash. Then it has then it has expansion. We have retrace, expansion, retrace, expansion, retrace. And dude, it's like fine. Also, a lot of countries have been like actually trying to buy Bitcoin. Like last I checked, it was El Salvador. El Salvador, entire economy now, I believe they're backup. They're using Bitcoin now as a backup currency, I believe. And then now Bitcoin, the way I see it is it's an asymmetric bet. So like I said earlier, when it comes to the money I'm actually investing, I'm doing 75% into things like the S&P, and I'm doing the other 25% into things like Bitcoin. With Bitcoin, the way I see it is like this. When I say an asymmetric bet, it means like this. Okay, so I believe the odds of Bitcoin working out are higher than 50%. But even if it was a coin flip, I do think it's worth risking 25% of my money on something like Bitcoin, because this is the thing, right? If Bitcoin crashes and goes to zero, which I don't think it is, but if it does, I'll still be fine because of the money I put into S&P. Obviously, I'll be kicking myself hindsight by like, oh, I should have just bought more S&P. Like, obviously, I'm gonna do that. But when you're thinking about it logically, it's like, okay, I can risk 25% of my money to literally get 10x returns. And it was like, oh, that's not gonna happen again. I'm not even gonna get into the market cap right now of Bitcoin and how much higher it can go reasonably, and it can go even higher than that. And it's crazy. There's just one projection. This guy, I can't even think of his name. He made a projection of Bitcoin when it was first created. I didn't remember what year it was. You guys can Google, you'll see it. And basically, he's pretty much been spot on. And he made this over like 10 years ago. And exactly where Bitcoin is now, he literally projected. I'm like, dude, there's something weird about that. I'm like, I'm gonna keep buying more Bitcoin. But like I said, I'm not here to convert anyone to Bitcoin. I don't have the evidence because that's not my plan. My only plan is I wanted this video to be like, you're at the table with your buddy and he just says a bunch of things that are really interesting and then you start to research about them because that's it. Now, risk management, this is the most important part of the video. So listen up. Okay, now this is why we're not 100% on Bitcoin. Like I just said, Bitcoin is an asymmetric bet. If it works out, great. Do I think the odds of Bitcoin working out are higher than 3%? Yes, I do. I think it's probably more of like a 75%, 80%, which is why I'm 25%. But this is the thing, right? Even if you aren't, completely, even if you don't have as much conviction on Bitcoin as me, I would say number one, do more research. And if from there you still don't have as much conviction, it doesn't hurt to put a small percentage of it. Like for example, I know a guy now who puts 3% of his portfolio in there. I know some people put in, 20%, 15%. I have a friend right now that's a maniac. Bro literally has $1 million plus in Bitcoin. And right now he is sitting in a lot of drawdown. I'm like, bro, I would not have my entire net worth on Bitcoin. I'm just gonna be real with you. I would not. But hey, this is the thing. If it works out, he's gonna be the richest man I know. But if it doesn't, this is my thing. Even if that doesn't happen, if it just goes down really low, like he loses 75% of his portfolio, and it does go back up, you got to ask yourself, can you weather that much drawdown mentally? And this is the thing too. When you're seeing a drawdown of $10,000 versus $100,000, it's not the same thing. Okay, so then why the S&P? If you do just the S&P, if you're 100% the S&P, right, you miss the upside because you're not taking any asymmetric bet. And then this is the thing. If you have no savings, you could basically, you're setting yourself up for failure when inevitably a recession comes. Because what happens is if you have no other money, you have bills to pay, you got laid off, well, guess what? If you're in drawdown, but you need money to pay your rent, you're going to sell even though you're in drawdown, and then you're going to lose money. Like, cool, I guess you could write off the losses to not pay tax on it, but it's like, you want to make money, right? Not reduce your tax bill. Not to mention, there's so many better ways to reduce your tax bill other than by losing money in the markets. So how do I invest, right? I do dollar cost averaging. So I'm not gonna lie, dollar cost averaging is something I definitely do, but with my awareness of the markets, I do it less, I will say that. But also guys, like I've also been I spent probably hundreds of hours, maybe almost 1,000 hours now on just looking at charts. So I will add that. But even still, I'll just dollar cost average, especially now with all it looks like the upcoming recession might be happening if we aren't already in it. So basically just dollar cost average. So basically what that means is every time you get paid, you put money in the markets no matter what. You always put the same amount, the same fixed amount. Because this is the thing, if you do it over a long enough time period, the numbers tend to pan out. Like I said, past results don't guarantee future results. So just to make it clear, if you make we'll just say like $2,000 a month, you make $2,000 a month, every time you get paid what, $500? And every time you get $500, you put $100 in the market. So every paycheck, you're putting $100 in the market no matter what. And this is the same thing, consistency. My most important thing is I get money throughout different times of the month because of what I do. So sometimes like I'll get paid completely randomly, right? So what I do is anytime cash hits my account, I invest a certain percentage. So for me, what I do is I have a target dollar amount. So I know every month I want to invest this amount of money. And if it's towards the end of the month and I haven't hit that thing, I'll just literally put the entire, if I get like a check for a certain amount of money, I'll put that entire amount in there just so I can hit my monthly goal. Assuming I actually don't have bills, I'm not going to get evicted or something like that, which would never happen, but you get what I'm saying. Now this is, as far as my investing philosophy, it's this, and that is simplicity, right? Less assets means we have less thinking to do. Because I remember there's a point where I'm like, oh, I got to buy small caps. I got to buy large caps. I got to buy gold. I got to buy silver. I got to buy Bitcoin. It was too much. I got to buy bonds. And then I realized, I'm like, let me just chill out. Let me just simplify my investment strategy. Let me just buy these two things. And I got to say, things have been going a lot better. just like mentally, overall, just mentally. But mental is huge because the less resistance there is the better. You want to gamify investing, okay? Now, this is the big thing I do want to talk about. I do think investing is important, but I don't think investing is as important if your income is low. Now, what I mean by that is if you can only afford to do $25 a month investing, you're not going to be able to retire for that. I'm just going to be real. Even in 30 years, you're not going to retire off $25 a month. So what you'd be better off doing is if you're at the point where your income is that low, spend that $25 on something that can increase your income. Like, for example, buy a book or something like that. I don't know, try to watch videos online for free. Subscribe to a school group or something. Something like that. Something to increase your money. I don't know, go back to school, go to trade school, get an education, something like that. There's tons of things people can do that are free to be able to increase your income, okay? You just got to get creative. And if you guys want me to talk about the things I've done to get creative, I've definitely done a lot of really weird things. Don't get me wrong, I've also spent thousands of dollars on on online education, but there was also a ton that I learned just by meeting people for free, stuff like that. And we didn't have avoid overthinking. Just start. If you make things if you're afraid, I feel like when it comes to investing, it's probably because you don't have enough information. I do think there comes a point where it's like you just need to just put your feet in the water. But the reason why I say that is because, for example, Bitcoin. I used to say Bitcoin's a scam for the longest time. Why? Because that's what the public said. Oh, I used to say, oh, Bitcoin, blah, 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 blah. And then sure enough, on a big portion of the companies on the S&P 500, a significant amount of these companies are buying Bitcoin. I mean, that's interesting. And you got the US dollar backing it. And I started looking at it more and more, and it became less scary, right? So I'm just saying, do your own research before you just come to conclusions. Even this video, don't take everything I'm saying as gospel. Now, I want to talk about what I'm doing now. I kind of have already done it, but I'm about to basically do two things. Let me tell you real quick what I'm doing. So right now, I am spending what? So my target goal is I try to invest at least $1,000 a month into investments, at least. But I usually try to shoot for 2,000 because basically, so I ran the numbers. I don't remember exactly, but if I continue to put in $2,000 a month, which is $24,000 a year, I'll have about 50 million by the time I'm 70. 50 million, I mean, who knows what we'll be able to buy with that, the rate at which inflation is going, but at this point, that is what it's projected. And I can tell you, I'm definitely on track because my net worth has been skyrocketing just because I stopped buying dumb stuff and just started pumping money in there. And obviously, I know not everyone can do $2,000. I know people that do more than that, but I know that is more than most people. And I'm not saying you should do that. I'm just telling you that's what I do right now. So I'm doing $1,000 minimum. $2,000 per month is my ideal target. And then from there, I'm putting about 10% of all the money I get is cash. So any 10% of all the money I'm getting, I'm putting aside as cash. And then I'm putting the rest of that money in the market. And honestly, right now, I do think a recession is coming, just based off like kind of the writings on the wall. I'm not going to get into current events right now, but it does seem like it is coming. Obviously, everyone always thinks the recession is coming, but now it's a little different. Hopefully I'm wrong. I want people to just come back and say, oh, everyone's wrong, like a bunch of fucking idiots. But, hopefully that is the case. But if I'm not, I will be ready because I've been increasing my cash reserves. So before, my cash was about, like I said, 10%. But now I am thinking about increasing to 20% and as high as 30% because that's exactly what Berkshire Hathaway is doing. And even right now, when you run all the numbers, like there's this thing called the Warren Buffett indicator, which is it is literally the most accurate indicator as far as market conditions. And even right now, they're not really buying anything. And tons of the billionaires have been selling all their assets. Like what I'm saying is the ratio between them buying and selling, they're selling more than they're buying. And then right now, everyone's saying the S&P is overvalued. And I definitely agree with that. But like I said, even though it is overvalued, we could be completely wrong. So I'm still dollar cost averaging. I'm just doing it like a little less. I'm putting more cash aside. And worst come to worst, I'm wrong. It takes off without me. I'll have more cash in the bank, so it's okay. But now we're gonna go on the computer, and then I'm gonna run you through basically a real quick analysis. Okay, so right now we're on calculator.net. This is the investment calculator. I think hands down, this is probably the best calculator for doing this kind of stuff. I also do wanna add this real quick before we get into this. As far as investing, in the rate at which you should invest, I would say if you're older, you should definitely basically reconsider. Because what I mean by this is, when you're younger, you can take more risk. So what I'm saying is, when you're young, you don't really need, you can have more money in the stocks, but as you age, you want to start to have more and more bonds. Because this is the thing, if you're 70 years old, you can't weather a recession. You just can't, because like you're not working, most likely you're probably retired. So having money that's not going to go down is even more important. But if you're younger, then you're fine to take more risk. And I would even say you can basically look up something on Google that basically says something like, basically cash to, or like you can look at like stock to bond ratio based off age. And you'll see tons and tons of graphs of people that like basically like financial advisors, and they'll basically explain to you, okay, you should buy this amount of stock based off your age. And I would say I'm actually pretty much following what it says now. Like, since I am between the age of 20 and 29, I'm buying basically 100% stocks. And I'm not even looking at bonds, because I know that I have so much time, I can pretty much weather any recession. All right, so now let's look at basically a compound interest calculator. So we're just gonna look at something very simple. We're gonna look at and say, okay, hey, you're gonna start investing $100 today. $100 a month after watching this video. And we're gonna assume that you're 20, because that's my average, viewer's age, between the age of 20 and 25. So assume you're 20. We'll just say you want to retire by the time you're 70. You'll probably retire before that, but if that's the case, right? This is assuming you only put in $100 a month, which, let's be real, typically the older you get, the more money you make. So you're going to be able to increase this number. But I believe everyone now can 100% afford. If you live in the Western country, you can 100% afford to put in at least $100 a month. So this is crazy, man. If you're putting in just $100 a month, by the time you're 50, you'll have over $357,000. And this was insane. You only put in $60,000, but you made $297,000 from interest. Interest is literally money you're making for doing nothing. Zilch, nada. Okay? So this is why interest is so important, because this is the thing. You can never outwork your money. You just can't. Once you get enough. Like, you want your money working for you all the time. Now, this is the thing. This is $100 a month, right? But even look at this. You're getting $32. And I feel like even after, after like 11 years, things get pretty crazy. But no, let's go even more aggressive. Let's look at 250. I feel like 250 is pretty reasonable. And this is crazy, because this is a 6% annual return. That this is even below the average return. So in the S&P, it averages 6.7% per year. So this is even below that, but you're still making bank. So if you're putting in only $250 a month, which isn't really that much more, look at how much more money you end up making at the end. Almost $1 million. You have about 900K by the time you're 70. Now you kind of get that. You guys can go in here and play around with the numbers yourself. But I just basically want to show you basically why I think 1,000 is pretty much like the golden number. And I do think it's really reasonable for most people. It's like you got to get creative, okay? So this is what I'm saying. If you put in 1,000 a month, I think ideally, long term, like I said, I'm definitely putting more than that. But you'll have like 3.5 million. Now you can definitely retire off 3.5 million by the time you're 70. Now this is the thing. Retiring off, $1 million, it's a little tougher in my eyes, but I don't think that's too crazy. But yeah, this just kind of gives you an idea. My point is, like, look at this. This is insane. $3 million is interest. You've only actually put in 600 grand. So this just kind of gives you an idea. You guys can play around with it. But yeah, that's pretty much it. So guys, if anything in here that I said wasn't the most, like politically correct thing or organized in the best manner, like I said, this is just supposed to be a video that's like chill. You're sitting with your buddy, me and you, we got a can of beer. We're talking at the table, right? Anything that I said that was unclear, do me a favor, comment it down below. But yeah, this is just the stuff I learned over the years, and I hope you guys found it helpful. I did put in a good amount of time in this, and I have not uploaded a video in maybe 6 or 7 months. All right, guys, I'll see you.